So welcome back to the channel. In today's class, we'll be looking at a very basic example. This was an ACCA exam question, HPR. All right, so we'll quickly look at that briefly. HPR, adverse processes. By the way, this question will be shown on your screen. Maybe you just screenshot, then you follow as I read on. So when we take this page off, you'll be able to make a reference to the question, and then we solve it together. HPR, adverse processes and roast coffee beans. The company has two divisions. When we were talking from the basic knowledge of transfer pricing, we said for transfer pricing to exist, there must be at least more than one division, right? So division P is located in country Y. It adverse and processes coffee beans. The processed coffee beans are sold to division R and external customers, which means division R can sell to internal division P, right? Can sell to internal division, which is division R, and also it can sell to external customer. Division R is located in country Z, and it roasts processed coffee beans and then sells to external customers. It means division R is only selling to external customers. Countries Y and Z use the same currency but have different taxation rates. Now, from the problems of transfer pricing, we said already that determination of ideal transfer price, the best ideal transfer price that will be acceptable by the tax authority is a problem. All right. And so from this illustration, they told us that these two divisions are in different countries and they have different tax rates. So which means that there are tendencies that the organization may be willing to move or will be trying to move revenue from one country or division to another division in another country. So the projected information for the next year is as follows. Division P, you have in capacity. Capacity here means how much quantity division P can actually produce. External demand for processed coffee beans, 800 tons, which is how much external customer is willing to buy. Demand from division R for processed coffee beans is 625. External selling price is 11,000. Variable cost is 7,000. Annual fixed cost is 1,005. And for division R, sales of roasted coffee beans is 500 tons. Market selling price for roasted coffee beans is 20,000 naira per ton. The production of 1 ton of roasted coffee beans requires an input of 1.25 tons of processed coffee beans. The cost of roasting is $2,000 per ton of input plus annual fixed cost of 1,000. This relates to division R now. Transfer pricing policy. Division P must satisfy the demand from division R for processed coffee beans before selling any to external customers. The transfer price for the processed coffee beans is variable cost plus 10 per ton. All right, variable cost plus 10 per ton. So in the exam, when you have transfer pricing question, one thing that they must always give you is what we call the transfer pricing policy. The policy means that how the organization actually wants to set the price. It could be based on ideal price, it could be based on cost plus, it could be based on full cost plus, it could be based on market price, it could be based on anything or negotiated and all that. But the good thing is, either ways, the examiner will always tell you what that policy is. And for this question, the transfer pricing policy, we are told that it's variable cost plus 10%, which means that whatever variable cost that the selling division has, just add 10% to it, which is variable cost multiplied by 1.21 in this case, which is a 10%, and that gives us the transfer price. The taxation rate on company profit is 45% in country Y, that's a bit high, and 25% in country Z. You are required to produce statement showing the budgeted profits after tax for the next year for each of the two divisions. Your profit statement should show sales and cost split into external sales and internal transfers where appropriate. All right. So for me, what we'll be doing here in this video, I don't want it to be too long. So we're dealing with just this AI first, and then maybe in another video or if time permits, we'll just look at these issues and then we'll take the other part, which is based on opportunity cost. All right. So let's quickly go into this. So the name of this question is HPR. HPR. And the A part is asking us profit statement. Profit statement. I want to do only for division R first, which is the selling division. Division R. Okay. So there. Every profit statement will start with sales. So I will have sales. And in this case, our sales will split into two. Remember, they told us that division R can sell to internal division and can also sell to external division. Alright, so this guy can sell to internal and can also sell to external division. Alright, so our sales, first one, let's sell to internal first. Internal sales. Alright, so all I will do is simple here. I will go to the requirement. They told me that division, demand from division. Okay, so sorry, this profit statement is actually for division P now. Division P, which is the selling division. Alright, so and they told us that the demand from division R for processed coffee beans is 625 tons. Alright, so division R is requesting 625 tons from division P. So our sales here, internal sales 625 multiplied by, they told us that the policy is variable cost plus 10%. Our variable cost here is 7,000 multiplied by 1.1. Alright? So now let's quickly do that. If I multiply 7,000 by 1.1, that's 7,700. 7,700. So multiply by 625. That should be 4,812,500. Alright, so I would have, is now my external sales. External sales. Remember that from this question, the total capacity for this company is 1,000 tons. So if we are giving 625 to internal, obviously what is going to be left for external will be 1,000 minus 625, and that's 375. So this will be 375 multiplied by external selling price, which means how much division P is selling to external market, and that's around 11,000 per ton. So I will have 11,000. 11,000. So if I multiply 11,000 by 375, all right, so I can have my total sales. So plus 4,812.5. Eight nine 8937.5. So this is our total sales. Don't forget we are dealing with only division P at the moment. So less variable cost. Variable cost, in total we have sold 625 to internal, 375 to external. That's the 1,000 their capacity. So I have 1,000
multiply by the available cost is 7,000. Right? So this will automatically give me 7,000. So if I take this out of this will give me contribution. Please, if you are having issues with all these small concepts, total sales, contribution, variable cost, please just put on the comment section so I can do a short video just to explain that to you. Alright? We don't judge, we only listen on this channel. So this is 1937.5. Alright, so they told us that there's a fixed cost here. What is the fixed cost here? The fixed cost for division P is 1,500. That's $1.5 million. So less fixed cost. Fixed cost here is 1,500. Don't forget, we have 3 zeros suspended. So if I take this out, minus 1,500, that should give me 437.5. Then tax. Less tax. At tax rate here is 45%. Yeah, in country wise 45%. 45%. So if I do 45% of this, multiply 0.45. That's 196.875. So minus 437.5, and this will give me 240.625. This is now their profit after tax. And don't forget, this is only for division P. Division P. Alright? Please compute for division R and put on the comment section. Alright? Compute for division R. Division R, which is the buying division. Buying division. Buying division. And put it on the comment section. Comment section. Alright? Thank you for watching. See you in the next video. In the next video, we're going to be looking at the issues around the transfer pricing, which is the B part of the question, and also we'll be looking at the C part of the question, which is talking about transfer pricing based on opportunity cost. Stay tuned. See you again. Bye-bye.